A lot of people think that tax efficiency is about what you invest in, but a more sophisticated approach shows that it's all about comprehensive strategy. The goal is to minimize tax drag, which is the annual erosion of your returns from capital gains and dividends, by strategically putting your assets in the most appropriate accounts. Why? Have you guys heard of ETFs? Well, if not, let's talk about it right now. From the IRS's point of view, the exchange traded funds, or ETFs, and traditional mutual funds are subject to capital gains and dividends tax. But their operational structures create a huge difference in tax efficiency. So if you heard of mutual funds, the problem with mutual funds is that they're actively managed, and there's a lot of buying and selling of the shares within the mutual funds throughout the year. Now, the buying and selling of these shares creates taxable events, right? That means the fund manager, if they want to buy more shares and then sell some off, the selling of it creates a taxable event, which then gets passed on to you, the taxpayer, the holder of the mutual funds. And that's why mutual funds have gone less popular throughout the years, because of how it's actively managed. Some fund managers may claim that mutual funds can beat the market, but overall, if you factor in capital gains tax, short term and long term, you might not be beating the market. If you're experiencing this tax drag on this actively managed fund. That's why ETFs, on the other hand, operate very differently. It doesn't require a fund manager to sell any of the underlying assets. To handle big money going in and out, the ETF manager creates creation units, large baskets of assets that are exchanged with institutional investors. This process generally avoids taxable events for you, making it rare for an index-based ETF to pay out capital gains. The structural difference is what makes ETFs a more tax-efficient choice than traditional mutual funds for your taxable accounts. So if you think about it, if you have an ETF, you contribute the same amount of money to an ETF as a mutual fund. Every year, let's say your mutual fund reports a small bit of capital gains, and every year you have to pay tax on the capital gains. That means each year you're losing a little bit of money to taxes. Whereas with an ETF, it's not actively managed. It's not having income tax related events every year, so that your money keeps growing without having to report all those capital gains.